Back on the election, you have two meetings, policy meetings before the election. There's some, mythology around the Fed and whether or not it raises interest rates ahead of elections. Will the upcoming election have any factor, do you think, in whether or not to keep rates the same or to possibly raise them?
No, I don't think the election would weigh on us one way or the other. I mean, I think as I said, if we decide to raise rates, it's because the economy is doing well. It's not because we're somehow worried about inflation overshooting in a major way. So it's not the beginning of a tightening cycle that's designed to squeeze off economic growth. It would be the start of, it would be continuation of a gradual to get back to a neutral monetary policy setting at a time where today we think monetary policy is still accommodative.
But there are some economists, and you mentioned it earlier, who believe that the uncertainty around the election is actually possibly having an impact on the economy. You mentioned business investment has been very, very weak. Is the election having an effect on economic growth? I
mean, it's hard to judge. I mean, historically, academics that have looked at this have found that election uncertainty does have consequences for business fixed investment. Because when uncertainty is high, there's an incentive to delay the investment until the uncertainty is resolved. But this doesn't really it's probably not going to have a meaningful consequence for the longer-term economic outlook, because we will have the election, the uncertainty will be resolved, and then investment will move forward. So, at worst, we're just displacing investment from one time period to a later time period. So I don't think it really has big consequences for the outlook.
So politics do not play.
I don't think they enter into our calculations.
Let me ask about inflation, because yesterday one of your colleagues, John Williams, president of the San Francisco Federal Reserve, suggested in a paper that the Fed change its 2% inflation target to actually raise it to something higher than 2%, given the current economic conditions, financial conditions, and the impact of Fed policy so far in a slow growth environment. The net effect of that would be to allow the Fed to keep rates lower for longer. What do you think of that idea?
Well, I think the issue that John was trying to get at is the fact that if the neutral short-term interest rate consistent with a neutral monetary policy is lower now than it's been in the past, the peak federal funds rate in this business cycle will probably be lower than it has been in the past, and therefore there won't be that much scope to lower that federal funds rate to support the economy the next time some adverse shock hits. And so in that environment, if you had a little bit more inflation, you could have a little bit higher terminal federal funds rate, and there'd be more room to adjust monetary policy. I agree with John's conclusion that it looks like the neutral real short-term interest rate is lower than it's been in the past, and it does suggest we should think about how are we going to make sure that we have enough policy tools, monetary policy tools, and fiscal policy tools to be able to get out of the next recession. But my own view is it's premature to talk about raising the inflation target. There's other ways to cope with an economic downturn. One thing that we have today that we didn't have 10 years ago is that we have a number of tools that we have actually shown to be effective in helping support the economy, such as forward guidance, such as quantitative easing, extending the duration of our portfolio. And so I think that, coupled with maybe a fiscal policy that takes on a larger role in economic downturns, might be sufficient. So I think it's really premature to jump to this notion that we need to raise the inflation target.
Finally, one other thing that you're watching, and the Fed's been watching closely, is international developments. The markets went nuts with Brexit. What is your assessment right now of the Brexit situation? Are you and the Fed concerned about the potential impact of Brexit now on the global economy and on the effects on the U.S. economy? And also, what do you think of what's going on in China right now, the slower growth there?
Well, I think in terms of Brexit, I mean, obviously the vote was a negative shock, certainly to the UK economy and by extension a bit to the global economy. But the market response to Brexit, which was quite negative in the very short term, was very short-lived. And so financial conditions globally have actually recovered. And so you would certainly say that the near-term consequences from Brexit on the global economy, in terms of their effects on financial conditions, have been very, very modest. I think there's still too soon, though, to fully assess the full impact of Brexit on the global economy. We know it's going to have consequences for the UK economy. That's going to ripple back into the European economy. There's also, the questions about the efficacy of monetary policy around the world in terms of will negative interest rates really actually support global economic growth. So my near-term risk about Brexit, I think, have diminished, but I think there's still some longer-term questions that still need to unfold.
And your assessment, analysis of what's going on in China?
Well, I think the Chinese economy was clearly going to slow over time for a number of reasons. One, income had reached levels where this slowing typically occurs in an economy. Number two, the demographic trends in China, partly due to the one-child policy, also point to slower growth over time. So I think expecting somewhat slower growth out of China is a completely reasonable view. They're getting slower growth, but it's still pretty good. I mean, it's running about 6.5% on a year-over-year basis. They're providing quite a bit of a stimulus to support that growth. So I don't see a near-term, shock likely to emanate from China over the near term, but that's obviously something that we continue to look at.
But
very
global
closely.
growth right now, I mean, we've seen the forecast from the IMF.
It's like okay. It's like it's continuing this pattern of maybe a little bit disappointing relative to forecasts, but I would say you would look at global growth and you'd say it's moderate.
How does it get better? Just continued central bank interventions?
Well, I think there's a number of things that can be done. I mean, obviously, making sure that the banking systems are, have sufficient capital and liquidity, I think, is important. One of the things that I think benefited the United States is that we were very aggressive about forcing our banking system to be recapitalized. So the banking system in the U.S. is actually providing, I think, a lot of support to the U.S. economy in terms of being able to supply credit to households and businesses. Other countries have been slower in terms of restructuring their banking system, so I think if they were more aggressive on that, that would be helpful. There's a lot of things that can be done outside of monetary policy. I mean, one of the problems probably has been that we've been relying too much on the monetary policy side and not enough on the rest of the government in terms of fiscal policy, in terms of structural reforms. In the United States, there's a whole bunch of things that could be undertaken: immigration policy, tax reform, job retraining. All these things could actually help lift the economy over the medium term.
All right, and we have an election coming up where those issues are on the table. So, but Bill Dudley, thanks for joining us today on Fox Business. And